evening and welcome to the brand new Startup Central. I'm Nayantara Rai in New Delhi. Apologies for starting a little late today. The Prime Minister, of course, responding to the to the President's address in Parliament. That's why Startup Central had to start late. But we've got a special lined up for you today on Startup Central. We are breaking a mega story right here on the channel. It's to do with a burning issue as far as the entire startup space goes, the technology goes, innovation goes. It's to do with differential voting rights, superior voting rights. Now, there's a practice in the United States and in the emerging and in the developed world where promoters and founders of technology companies actually enjoy superior voting rights. So when you look at companies like Amazon, Google, Facebook, so many of them, while the promoters and the founders don't hold that much stake, they're still in the driver's seat, primarily because they have these superior voting rights. It's been a burning issue. Should India go down this path? The flashes are on the bottom of your screens, and we are now going to be addressing that. I'm being told by my sources that come June 27th, the SEBI board will be discussing differential voting rights, called superior voting rights, where it is actually going to be discussing before an IPO, can founders of technology startups have differential voting rights? That is the entire plan that we're being told is going to be discussed at the SEBI board. So it's going to allow the founders and innovators to have superior voting rights in technology companies, but with riders. These could, for example, be that the superior voting rights of shares should not cross 74% post-IPO. For corporate governance standards, we are also being told by our sources that 2/3 of the board, as well as the entire audit committee, is going to comprise of independent directors. Shareholders with superior voting rights must not be part of the promoter group with a net worth of more than 500 crore rupees. If those with superior voting rights have to continue enjoying them, they must stay in executive roles. What's on your screen now is the likely ratio, 2:1 to a maximum 10:1 of ordinary shares. We believe that's a big proposal that the SEBI board is indeed going to be discussing. There's also a sunset clause. The sunset clause is that shareholders without superior rights, it's going to stay for 5 years. That means shareholders with superior rights can only stay for 5 years after an IPO. Then those superior shares will become ordinary shares. However, if there is to be an extension, the extension to that must be signed off by the non-founding promoter group. That means if you're not a founder, if you're not part of the promoter group, if you don't have the superior shares, only then can you vote for the extension. So these are some of the riders. What's it going to mean for the startup universe? So with that, let me invite all the 4 guests that are joining me at the moment. I've got Ramesh Kailasam from India Tech. He is representing an association of founders. Founders like Ola, that founded Ola, founders like Deep Kalra of Make My Trip. So he's representing all the founders that are in favor of the superior voting rights. I've also got Vaibhav Kakkar. He's from LNL. I'm also being joined right now by Ashish Goyal from Urban Ladder, as well as Siddharth Pai. Thanks a lot, gentlemen, for joining us here. Ramesh, I'm going to come to you first, simply because you're representing the founders. There are a lot of caveats if you're going to see the superior voting rights come into play, and that really is going to be that the founders cannot be part of a promoter group which has more than 500 crore rupees of net worth. If that's going to be the case, some of the largest founders of this country will be excluded from getting superior voting rights. Whether it's Bhavesh Agarwal of Ola, whether it's Vijay Shankar Sharma of Paytm, or whether it's Deep Kalra of Make My Trip. What's your initial reaction?
Well, I mean, this proposal, first of all, I mean, India Tech has been in the forefront of pushing for differential voting rights. We started this whole effort somewhere around August of 2018. And since then, it has been quite a journey. We had submitted detailed representations and white paper to both the SEBI and Government of India right up to the PMO. So it's heartening to know that at least there's a change of stance and SEBI has warmed up to the idea of DVRs. it's also equally important that the listing process be looked at, because the pre-qual criteria for listing still remains something we need to look at. But coming to your point on the promoter bit, that's a clause we need to certainly look at on what it exactly means in the fine print, because it could also mean that you are an existing promoter of a large group and you are starting this new startup of an internet company or anything of that sort, where you could be excluded from listing because you are already part of an existing group. But if you look at the fine print, I guess, I mean, from our discussions with SEBI, they were looking at something like a net worth of 500 crores, which doesn't necessarily apply for the companies we are talking about. And therefore it will be interesting to see what the formula they put in place to calculate this, and who qualifies and does not qualify. So for my initial reaction, I wouldn't be necessarily looking at it until I get the fine print on what it entails and who is included and who is not. But overall, yes, I mean, it's a great initiative from SEBI to have opened up.
I would like to caveat this is, of course, source-based information. This is for my viewers. This is what I'm being told by my sources is likely to come up on June 27th. It's been an issue that has been debated. You've seen public comments that have also come in. I'm going to ask my producers to also now show you some of the largest founders in the world and how they are in the driver's seat. That particular slide is now going to come up for you, and you can see the kind of tech companies that have actually been able to rise to the levels that they have today simply because the founders have been able to meet their vision. Let's bring that up. The Googles and the Facebooks of this world, the founders, the Mark Zuckerbergs, the Larry Page, Jeff Bezos of Amazon, while they don't enjoy the kind of, the number of shares that they may hold, it's only because they have Class A shares. Those Class A shares with superior voting rights, which allows them. We'll bring up that slide for you as far as the Facebook and the Googles of this world goes. But Vaibhav Kakkar, if I could now come to you. You know, we talk about when are we going to have a Google? When are we going to have a Facebook? It's the vision of the government. We have some very enterprising founders. Look, for example, at the kind of unicorns we already have. India's poised to have 100 unicorns by 2025. We're talking about $87 billion by 2025. So having said that, this supporting legislation, which could come in the form of the SEBI board meet, I've taken you through some of the parameters that are being discussed. Yes, there is a difference from what it might be there in the United States, particularly the net worth clause or the sunset clause of 5 years. It's a step, but a step in the right direction. Would you have wanted to see a bigger step?
So, Nentara, I couldn't get the last part of your statement. Can you just repeat that?
I was asking you that this is, of course, a big step when it actually comes up, when we do see differential voting rise. There are those that are very for it, many that are against it. But if we are going to have 100 unicorns by 2025, you will still want these founders to be in the driving seat. It's happening in the world's largest companies, whether it's an Amazon, whether it's a Facebook, whether it's a Google.
Absolutely. I think overall, I think it's a great move. It is a step in the right direction. The SEBI consultation paper, which was released a few months back, pretty much, gave the signal of which direction the regulator would be moving. One would await the fine print. But overall, I think the context in which some of these changes are being suggested is absolutely the right thing to do. If you look at the startup community and how startups have grown, it is a fact, it's an accepted fact that startups have grown on the back of multiple rounds of capital raise, and the entrepreneurs or the so-called promoters of these companies, by the time they've done a Series F or a Series G round, they are down to 8 to 10%. So you need to incentivize these promoters to believe that they can continue with their vision, with their plan, and can keep raising capital for building their business without being concerned overly about giving up and ceding control. I think the other point, Nentara, which I'd like to touch upon is I think everybody is going to also, watch out for what Ministry of Corporate Affairs does, because the current Ministry of Corporate Affairs rules very clearly ban companies that do not have a 3-year profit track record to issue shares with differential voting rights. So practically a number of startups, irrespective of whatever SEBI comes up with its framework, will not be eligible to be able to issue DVRs simply because they're not making profit at this stage and they're focusing on building revenue, building user base. So it would be important that SEBI taking these moves would be the right step, but then of course it has to be backed by Ministry of Corporate Affairs also very quickly moving and amending the company rules to allow not profit making companies in the startup world to be able to issue DVRs.
So that come in on that particular point, you anyway have a profit-backed rule that exists in the country when it comes to IPOs as well as superior shares. Now you're going to have a net worth clause that is going to come in. So if your net worth, the promoter net worth is more than 500 crore rupees, you can't even be eligible for startups. And the sunset clause of 5 years, is 5 years too little?
First thing we should do is acknowledge the fact that SEBI is now entertaining the idea of DVRs now, which is a great step forward because in 2009, if I'm not mistaken, there was a concept of DVRs, but SEBI actually removed that out for some of the listed companies. So it didn't allow any of them to actually go and reissue it. That being said, so I think a lot of people expected these sort of riders to come in. The rider of a net worth of 500 crores in this particular regard is a little premature because if you look at the net worth of any of the large unicorn founders, even though they may hold a 8 to 10% stake, as Vaibhav alluded to as well, that 8 to 10% stake actually translates to close to about 3,000 to 4,000 crores. That's easily equal to a net worth of about 500 to 600 billion, if not 1 billion as well. So the net worth of 500 crores actually excludes this entire layer away, and which in turn actually the proposal that's being mooted as important for us. It's important the need of listing these companies while simultaneously ensuring that minority shareholders are also taken care of. I constantly comes out the net. The 5-year clause can actually exist with another extension period of another 5 years. This will actually incentivize. This will actually ensure that there is some amount of governance that also comes into this, and so that none of these particular DVRs or differential voting rights are actually used against the broader interests of the company and for the promoter group itself. So all in all, it's been a great step forward. There are multiple changes and multiple rules that have to come in. As you mentioned, the profitability rule, in my personal opinion, should be relaxed in terms of listing and DVRs, because as of now, we enter an entirely new paradigm in the world where profitability is now being sacrificed for growth. And when the companies eventually grow to a certain scale, they will become profitable. If anyone's followed the rise of what Facebook has done, Facebook was grossly unprofitable for a long time. They listed it, the stock price tanked, and now it's one of the largest companies in the entire world. So all these companies can become profitable if they sacrifice growth, but until they hit that certain level or those certain metrics, they want to keep pumping in capital to ensure that they can grow. And DVRs actually allow them to reach out to the public markets and therefore ensure that a broader percentage of the population can actually participate in these growth stories.
Ashish, come in there. You just heard, you've heard the other panelists and what they, what they've had to say. The point also is that the flip side, let's play the role of a devil's advocate as well. There are a lot of those that are against differential voting rights simply because it brings a lot of power in the hands of the founders. While we talk about the stupendous rise of Facebook, we should also not perhaps forget various events that have taken place in the past. For example, the elections. You've also seen the congressional hearing. Having said that, there are also charges that, is Facebook, for example, autocratic. So while we want to ape the West, while we want to pick up the best, it's necessary to cherry pick as well. How can we ensure that the founders' interest will also be in the larger interests of the company? Because, once that rises, does that always happen?
Right. See, I think all of us are agreeing that this is absolutely the and probably long. I would actually not worry so much about too much power in the founding act, because really speaking across the spectrum, regulators have done a great job of providing that governance, whether it's in our public markets, our banking system, so on. So I'm pretty sure SEBI or the corporate affairs groups will make these challenges that you talk about not real. That being said, I think right now what we have to acknowledge is that founders having equity holding is actually a real problem for continued excitement and sense of ownership for founders. And solve that yes, I think is imperative. Of course, it has to be done in the right governance, but it has to be done. It has to be done clearly and ambiguously.
Okay, we do have Ashish not on the best Skype line. Perils of live television is not just poor connectivity. Sometimes in 2G is now happening even when we talk about data services. Gentlemen, I know I've kept you waiting for a while. The Prime Minister had been talking in Parliament, which is why the show started late. But stay with us. We're taking a short commercial break. Stay tuned to the special edition of the Startup Central. We're going to be back. We're breaking this big story. It's a burning issue when it comes to the new economy, to the startup universe, entrepreneurs, as well as the innovators. We'll be back in less than 2 minutes. Welcome back. You're watching this very special edition of Startup Central. I'm Nayantara Rai. We're breaking a big story on this edition of Startup Central. It's to do with the upcoming board meet of the market regulator SEBI, where it's finally going to be discussing to looking at introducing a framework for differential voting rights, superior voting rights only for the founders of technology firms. There are lots of riders, though. The founders should not be part of a promoter group with a net worth of more than 500 crore rupees. The total voting, superior voting right share should not be more than 74%. They should not. The sunset clause also of 5 years. As far as corporate governance issues go, they've said the entire audit committee and the independent directors should comprise 2/3 of the board. So let me go back to my guests. We've got a high-level panel to discuss this with you. It's a burning issue, and I'm sure all of them will be back on June 27th as well. Ramesh, I'm going to come back to you. You know, you're representing all the founders that we have in India on the startup street right here. I know you had expected a lot from the market regulator when it actually came to the differential voting rights, the superior voting rights. There will obviously be a lot of riders. Having said that, what do you make of the corporate governance issue? Because there really has been a lot of problems when it comes to corporate governance. We've seen a lot of people talk about it in Singapore, Hong Kong, the United States, that you can see founders become autocratic. Having said that, 5-year sunset clause, is it, too little? Because there's also a profitability clause.
Yeah, so we did look at all of those, and it's been a journey for us as well in the last 6 months, ever since we took up this issue with the SEBI and Government of India. If you look at the listing per se, we had the minimum 20% promoter requirement, the net fixed assets requirement, the profitability clause, track record, and so on. We had represented on those as well, which is in fact a parallel discussion we have been having with SEBI. And when it came to DVRs, we made it, and as part of the representation that we had put in, we had pushed for the fact that on the sunset clause, ideally promoters need to, why are we asking for DVRs in the first place? Is for that promoter who is passionate to run it in the long run, be able to survive and run it. It does not certainly come with freebies on corporate governance. We had made it amply clear in our submissions that all these are not meant to support or create any Ponzi schemes. In fact, we are asking for genuine businesses that are coming in this space, and which is why we qualified and asked this particularly for the tech sector, and more so with the internet-based companies, anybody who has an app and who delivers goods or services as part of the ask. As far as the sunset clause is concerned, our take was, and we did look at other geographies, our ideal ask was that there should be no sunset clause. And should there be one, our ask was that it should be 15 plus 5 years. In fact, the clauses around extension were what we suggested to SEBI, that in fact that it should be an ordinary shareholders meeting where they should decide on the extension. So on the checks and balances front as well, we were asking for was also to look at, these are asset light business models. These are not companies which are to be judged on the conventional business models of big brick and mortar, or for that matter factories producing goods. These are asset-light models which innovate and create a disruption, but which connect the old economies with the consumer, and therefore are the new age businesses that are coming in. Our point of submission has always been that the government should recognize these business models exist. They should also recognize the fact that founders who run these business models create an alternative form of growth, which could be either gross merchandise value or customer acquisition and so on, and therefore cannot be judged on precincts of profitability and so on, which is evident from other parts of the world. We did see Hong Kong and Singapore dilute their stance after realizing that they need to accommodate for these models. Last week we saw China doing the same. So there are jurisdictions which are recognizing this model, and all we said was that if we have to create the next big names,
Ramesh,
we need
I
to
got
have
your
these
point.
roofs knocked off.
Right,
which is
I got your
typical
point.
of what
I got your point. I think you made your point really well, Ramesh. And we will be having to take another short commercial break. But before I do that, Weber, if I could ask you this one question: if there were superior voting rights, what does it really mean as far as M&A activity goes, as far as hostile takeovers go? We haven't, you have seen a lot of fights in that sense in the startup world. You have seen a lot of big bang acquisitions led primarily by the fund houses, whether, it's the soft banks of the world. But if I were to juxtapose that to the biggest hostile takeover battle we've seen recently, it has been of L&T and Mindtree. So what is this going to mean for the M&A activity in the country?
So I think that's a very good question, Antara. I think this particular rule change is meant to actually give confidence to the promoters that they will have the continuity of control on their ventures, and they can continue expanding, they can continue raising capital without being conflated with fears of somebody taking away hostile control of the company. You mentioned Mindtree. If the rules of SEBI framework at the point in time when Mindtree went for an IPO would have allowed promoters to have a more meaningful stake through differential voting rights, certainly today with 15% stake that they could not ward off the hostile bid from L&T, that would not have been the case, and they would have had some ability to influence the outcome of that. I think at this juncture, I want to make this point, Nayantara, that if you look at the World Bank rankings on ease of doing business, one parameter that we've consistently done well is minority governance and shareholder governance. So we have plenty of things going there. And as far as the checks and balances are concerned, there are already inbuilt number of checks and balances that are being proposed in the SEBI framework, whether it relates to the coattail provisions, whether it is sunset. Even on sunset, at least the SEBI consultation paper talks about an extended sunset with special resolution of the shareholders where the promoters cannot vote. So promoters are being given enough confidence with this sort of move that any adverse M&A where they are not on the same page at least can be stopped. And I think this is the right sentiment that you need to give entrepreneurs. They don't need to be, compromised and feeling concerned about hostile offers and hostile acquisitions when their focus should be on business. So I think all in all, a great step. And once, of course, a merger and acquisition is taking place, their DVRs will go away. That's an obvious one. And I don't think that's any rocket science or any concern there. But essentially, ability for them to ward off hostile offers is an inherent concern that every promoter who's looking at building more and more capital for the company has always had to face. And that takes care of that issue.
Vaibhav, I got your point. So let me take that across now to Ashish of Urban Ladder. What is this going to mean? Are you're going to feel more empowered? So when you go in for the fundraising exercise, if this were to come through, you know that you'll have the superior voting right shares. Would it also make founders more comfortable to access and tap capital? Because we do hear cases of founders being scared they're going to be diluted, but they need the capital. They don't get credit easily from the banks. That may not necessarily be the way they want to go. And, what is this going to mean for that fundraising drive when the promoter needs to go for one? Will it take a lot of burden off?
I think definitely it's makes some of the emotional journey easier. one thing that I'm not sure about, I'm not seeing how the SEBI wants to think about this.
Ashish, we have you on Ashish, we have you on a very bad line. I'm going to ask my producers to reconnect with you. It's a terrible line. So I tell you what, we're going to take a short commercial break. Stay tuned. We'll be back, and we're still continuing to talk about superior voting rights and the impact is going to happen as India is continuing to find the next club of unicorns. Welcome back. You're watching Startup Central right here on ET Now with me, Nayantara Rai. We are discussing the differential voting rights that may just become a reality come June 27th if the SEBI board signs off on it. On Startup Central today, we've broken an exclusive story on the proposal that is before the SEBI board, the kind of framework that you're likely to see. I've also got a big bang panel with me where we're covering all the bases. The four gentlemen are going to come up for you on your screens. I'm going to go back. Siddharth Pai is still with us. Siddharth, we were talking before the break about whether founders would feel more comfortable fundraising because they've always felt they have to cede control. They can't access the debt markets very easily. And there's always this fear that the people that they're going to for the money are going to take away from their vision. They're going to be in the driver's seat. They're going to drive decision making. If that is really the case, won't investors, as a corollary, be worried about it? Because if they don't get the right and they don't get to say what their money should bring to the table, then why would they be interested? After all, it's them who's putting their money on the table.
That's actually true. So what we early stages of none of the investors but as people already mentioned, it's a series there. Founder and the promoter the company as well. But founder doesn't have any active incentive to actually stay with the company, and many of them end up fighting to actually ensure some amount of control. As you've seen recently with the funding rounds that have happened, several founders and promoters from Ola, from Oyo, from Razorpay recently also actually very strictly and contractually state that they will have control of the board, and they will also have a veto right on certain matters. So this has become part and parcel of the entire venture capital industry as of now. It's important for this to also translate into the public listed space to induce these startups to actually go and list. If you look at the startup story across the entire world, India doesn't have many startups that have actually gone and listed. We've had Make My Trip who actually gone and listed listed in the US. Several of them are actually exploring listing in Singapore. Whereas if you look at one of the reasons why they go and list is because these particular stock markets and regulations offer these sort of inducements to ensure that the promoters still retain some amount of control within the company. Now, granted that this control may be abused by certain people, but as another panelist also brought up, it's important for us to understand that technology ventures and internet companies in this particular day and age, the promoters no longer majority of the company. They're minority in the company. It's the investors and the other shareholders who hold the bulk of it. Whereas the entire onus of running the company falls on the promoters' voice is equally important to actually be heard in this particular regard. Thereby, DVRs actually become an essential inducement for them to go and vote. If you look at the largest companies in the world, Google has DVRs, Facebook has DVRs, Amazon has DVRs, Alibaba in the US also has DVRs. Now, all these companies also ensure that they have the highest shareholding governance standards. And in the SEBI regulations, there are ample regulations around ensuring minority protection. Even in terms of ease of doing business, we rank very high when it comes to that. Now, it's important for these startup companies to start listing, otherwise they remain private forever, and our stock markets and the listed space are actually robbed of the excitement and the value creation that comes with them. And the DBR regulations, while they're good, I believe they should be eased out over time as well to make them a little more friendly towards founders to list. And in case and the existing
Siddharth, if they don't tap the capital markets, if they don't tap the capital markets, you brought up, for example, only the Make My Trip example. So that if they don't tap the capital markets, the big problem also is going to be that you're not going to see the likes of SoftBank, Alibaba, the large venture capital funds, all of them continuing to invest in this space, including private equity, because how are they going to get their exit? You can't keep, having funds buy out funds. So having said that, if I could now go across to Harshil Mathur, because we just heard Siddharth Pai actually bring out the Razorpay example, where he said, I believe we have Harshil Mathur of Razorpay with us. Harshil, we just heard Siddharth Pai talk about your company and about how you were able to protect your interests during the term sheet stage and what you signed with the investors. Is that indeed the case? Is this also now a growing trend? And then if that is also the case, does it still make necessary to have dual voting rights?
Yeah, we recently did something similar because we were really worried about founder control as the company gets diluted in subsequent rounds of funding. And we did a lot of provisions to ensure that while we get diluted, we still have more than 40% ownership, but as we get diluted, we don't lose control of major decisions of the company, like whether it's exit, whether it's IPO, or whether it's change of management. And the reason for that is that, one, while you said that major reason for investors to invest in a company is a financial return and loss. It's not for the purpose of taking control. So when you're in the right stage of the company, you can negotiate for such things and still ensure that the investors would be interested to invest in the company as long as they believe they'll have investor return at the end of it. So as long as the economic return is guaranteed, investors generally not that much concerned on it. It's just that in India, that's not taken up as a trend so far. We one of the first ones to initiate something like this. And fortunately for us, we had investors who were willing to give us that.
Okay, so there's some very valid points you've raised there, Harshil, and if I could now go back to Ramesh to take these points. Siddharth Pai just raised some very valid concerns, Ramesh, where he talked about, accessing capital markets, how it's going to bring about that kind of confidence, which is certainly needed. So when we talk about that, Ramesh, do you agree with that? Because on the other hand, you've just heard Razorpay and Harshil Mathur confirm that, yes, they've been able to protect their rights with the kind of documents that they have been signing. And can you explain to us why would startups start looking at capital markets if they were to get these superior voting rights?
Well, there are two things. I mean, like you can always currently issue differential votes, stocks with differential votes. But when you go for listing today, it's a parallel activity. You will have to go through the same listing process for two sets of shares, one with ordinary and one with superior voting rights. It's quite a monotonous process, and I mean, you do have those instances with Tata Motors on the ground, but that is not how the world functions today. I mean, if you look at the tech companies, these are superior voting rights which are available with the founders, which at times of voting come into play and help the founders maintain control over certain important decisions on operations of the business. Of course, with the checks and balances involved, it's not a blanket kind of a power they enjoy, but in matters that are essential, they do enjoy. But if you look at the listing process, that currently is not available in the manner in which it should be. And the SEBI attempt and the consultation paper that comes towards this direction is actually moving in the right direction towards making this happen. If you look at even, I mean, I've been speaking to founders over the past few months on this topic. Interestingly, I came across recently a startup which was saying that the investor who is coming in for this company is actually telling the company to set up an overseas holding company because Indian market is not conducive enough for IPOs and listing because those norms don't exist, and so also DVRs. So we are seeing even the other side where certain investors are actually putting this as a requirement, saying that if this was open, I would be more than happy to fund in India itself, and you don't end up opening multiple companies in different parts of the world. So that is largely the place from where I'm coming from.
Okay, so those are very valid points that you've raised. But Ramesh, the point also is that if you go through the proposal that is going to be there before the SEBI board meet, and it's a point I raised with you that 500 crore rupee net worth, if that's what the founder is part of when it comes to the promoter group, are we talking about a very small club that can enjoy the superior voting rights? add to the fact that, you have to be profitable for almost 3 years. Vaibhav Kakkar, you're the lawyer with us. When you put all of this together, do you think these are too many restrictions at a time when, people like you are anyway signing deals like Harshal Mathur of Razorpay just brought about, Siddharth Pai talked to us about it, where you are anyway protecting founders to the best way possible. At the same time, you're coming out with something which is going to restrict the club that can enjoy the superior voting rights. We don't even know as yet what the Ministry of Corporate Affairs is going to sign off to.
That is correct, Nayantara. I think, first of all, this 500 crore point that you've mentioned is somewhat surprising because the SEBI consultation paper did not allude to any kind of minimum requirements to that effect. Having said so, one would need to see what the fine print is. I think the other point would be, what would be interesting is to evaluate as to whether this 500 crore requirement, excludes their existing holding in the very company in which they're seeking DVR. I think the whole logic which is premised on enabling startup companies to be able to raise capital without diluting voting control is premised on the fact that these promoters do not have their own money to be able to continually fund the company along with the investors, and therefore they will get diluted, and they need to therefore then protect them against that dilution. I think it's with that principle in mind they're saying that if you're a promoter with less than 500 crore capital, it's only guys like you that need protection from these kind of constructs and allow you to have disproportionate voting rights and control. I suspect that if the worth would be worth emanating on account of value in the shares of that very own company, so if it's the Ola founder or if it's the Make My Trip founder and so on and so forth, their own worth from that own company will get excluded. Otherwise, the whole purpose of building startup companies into unicorns and so on and so forth will get defeated. I think the overarching point, Nayantara, is that there has to be an attitudinal shift. I think all along since last 50, 60 years, there's always been a thought with everything going around us that promoters are the bad boys. It's the minority shareholder that always needs to be protected. As I mentioned earlier, I think the ease of doing business rankings globally tells us that we've done really well on that account. I think the regulators always just keep into account the minority interest, never look at the promoter's interest. And I think if we have to build Startup India in a way that the new startups are the wave of economic growth, you have to incentivize promoters. I think with that construct, I think this is a win-win for all. And whatever the SEBI consultation paper suggested as checks and balances already seems rather little too excessive. So I'm not worried about abuse. I'm worried about the purpose getting defeated.
Purpose could very well get defeated if we don't see some of these checks and balances being diluted. We are running out of time. I do believe the Manas, the investor relations head of Grofers, is now with us as well. Manas, we've broken this big story on differential voting rights. Lots of riders that we've been talking about. We just had Vaibhav Kakkar of L&L partner at L&L talk about maybe the purpose could be defeated. At Grofers, at food delivery companies, you guys have so many regulations you anyway have to deal with. Maybe a lot more than other startups. Having then said that, if the superior voting rights were to become a reality with the kind of riders we're talking about, what's it going to mean for companies like yours?
Hey, Nayantara. So I think this is something which is a very important thing and a step in the right direction from SEBI. I think what we feel at Grofers is that this is something where they've recognized the importance of something which was missing in the Indian startup ecosystem, and they've actually given the empowerment to this entrepreneur to actually pursue his dream. I completely agree with the other panelists that there needs to be checks and balances in place. And of course, as the policy comes out, it will be a consultative process. So once we go through the fine print, we will obviously improvise on that. But right now, at Grofers, we actually welcome the proactive stance that is being taken by SEBI, and we are extremely positive about it.
Okay, Manas, unfortunately, we're completely out of time. I'd also like to thank all of my panelists for joining me today for this Startup Central exclusive story only We have all the details when it comes to SEBI's board meet. Yesterday, we told you about how pledged shares, there could be a crackdown. Today, we're telling you what the impact could be on the startup street after the board meet. We had to start the show late, so I know all my guests were very patiently waiting, but you know, the Prime Minister was speaking in Parliament. With that, it's a wrap. Many thanks for tuning in. Come back tomorrow at 6 p.m. We have another very special edition of Startup Central planned.